Welcome to our deep dive into the world of mergers and acquisitions, often referred to as M&A within the finance industry. In this video, we'll unravel what M&A really means, why companies pursue these strategies, and how they reshape entire industries. Whether you're a finance enthusiast, a business professional, or simply curious about how big deals happen, this journey will provide you with valuable insights. Let's start by understanding the basics of mergers and acquisitions and why they are such pivotal events in the financial world. Merger occurs when two companies combine to form a single new entity. This is usually a mutual decision, where both organizations see benefits in joining forces. Mergers can help companies expand their market reach, improve efficiencies, or gain access to new technologies. In the financial world, mergers are often seen as a way to create stronger, more competitive businesses. Understanding the motivations behind mergers is key to grasping their impact on the market. Acquisitions, on the other hand, involve one company purchasing another. This can be friendly or hostile depending on whether the target company agrees to the deal. Acquisitions allow companies to quickly enter new markets, acquire valuable assets, or eliminate competition. In finance, acquisitions are often strategic moves to boost growth or diversify offerings. The process can be complex, involving negotiations, due diligence, and regulatory approval. While mergers and acquisitions are often mentioned together, they have distinct differences. Mergers typically involve two companies of similar size coming together, while acquisitions usually see a larger company absorbing a smaller one. The dynamics, motivations, and outcomes can vary greatly. Understanding these differences helps clarify why companies choose one path over the other and what it means for stakeholders. Mergers and acquisitions have a long history in the financial world. From the early days of industrialization to the modern era, M&A activity has shaped the landscape of global business. Iconic deals such as the merger of Exxon and Mobil or the acquisition of WhatsApp by Facebook have made headlines and set new precedents. By looking at historical examples, we can better understand the evolution and significance of M&A in finance. Companies pursue mergers and acquisitions for a variety of reasons. Some seek to achieve economies of scale, reducing costs by combining operations. Others aim to expand their product lines, enter new markets, or acquire innovative technologies. Sometimes M&A is driven by the desire to eliminate competition or respond to industry changes. Each deal is unique, shaped by the specific goals and challenges of the companies involved. There are several types of mergers, each with its own characteristics. Horizontal mergers occur between companies in the same industry, often competitors. Vertical mergers involve companies at different stages of the supply chain, such as a manufacturer merging with a supplier. Conglomerate mergers bring together companies from unrelated industries. Understanding these types helps clarify the strategic thinking behind each deal. Horizontal mergers are perhaps the most common type, involving companies that operate in the same industry and often compete directly. These mergers can help companies increase market share, reduce competition, and achieve greater efficiencies. However, they can also attract regulatory scrutiny, as authorities want to prevent monopolies and ensure fair competition. Notable examples include the merger of two major airlines or telecommunications firms. Vertical mergers bring together companies at different stages of the production process. For example, a car manufacturer might merge with a parts supplier. These deals can streamline operations, reduce costs, and improve supply chain control. Vertical mergers are often less controversial than horizontal ones, but they still require careful planning to ensure integration success and avoid potential pitfalls. Conglomerate mergers involve companies from unrelated industries coming together. These deals are often driven by the desire to diversify business interests and reduce risk. For example, a technology company might merge with a food manufacturer. While conglomerate mergers can create new opportunities, they also present challenges in managing diverse operations and maintaining focus. Acquisitions can be friendly or hostile. In a friendly takeover, both companies agree on the terms and work together to complete the deal. In a hostile takeover, the acquiring company attempts to purchase the target without its consent, often by buying shares directly from shareholders. Hostile takeovers can lead to intense negotiations and legal battles, making them some of the most dramatic events in finance. The process of completing a merger or acquisition is complex and involves several stages. It typically starts with identifying potential targets, followed by negotiations, due diligence, and finally, closing the deal. Each stage requires careful planning, expert advice, and thorough analysis to ensure a successful outcome. Let's break down each step to see how deals come together. First step in any M&A deal is identifying suitable targets. Companies look for potential partners or acquisition candidates that align with their strategic goals. This involves market research, financial analysis, and sometimes confidential discussions. The right target can make all the difference in the success of a deal. Once a target is identified, the negotiation phase begins. Both parties discuss terms including price, structure, and future plans. Negotiations can be lengthy and require compromise from both sides. The goal is to reach an agreement that benefits everyone involved and sets the stage for a smooth transition. Due diligence is a critical step in the M&A process. It involves a thorough investigation of the target company's finances, operations, legal standing, and risks. This helps the acquiring company make informed decisions and avoid unpleasant surprises after the deal is closed. Due diligence can take weeks or even months, depending on the complexity of the business. Any M&A deals require approval from government regulators. Authorities review the deal to ensure it doesn't harm competition or create monopolies. This step can be time-consuming and sometimes leads to changes in the deal structure. Regulatory approval is especially important in industries like finance, healthcare, and telecommunications. After negotiations, due diligence, and regulatory approvals, the deal is ready to close. This involves signing final agreements, transferring ownership, and announcing the deal to the public. Closing is a major milestone, but it's just the beginning of the integration process. Both companies must now work together to realize the benefits of the merger or acquisition. Integration is often the most challenging part of any M&A deal. Companies must combine operations, cultures, and systems while keeping business running smoothly. Successful integration requires strong leadership, clear communication, and careful planning. The goal is to achieve the synergies and benefits that motivated the deal in the first place. Investment banks play a crucial role in mergers and acquisitions. They advise companies on deal strategy, help with negotiations, and arrange financing. Investment banks also assist with due diligence and regulatory filings. Their expertise is invaluable in navigating the complexities of large transactions and ensuring deals are structured for success. Legal issues are a major part of any M&A transaction. Lawyers review contracts, ensure compliance with laws, and handle any disputes that arise. They also help structure deals to minimize risk and protect the interests of both parties. Without careful legal guidance, even the best planned deals can run into trouble. Mergers and acquisitions often require significant financing. Companies may use cash, stock, or a combination of both to pay for deals. Sometimes they take on debt or raise funds through capital markets. The choice of financing affects the deal's structure, risk, and potential returns. Financial advisors help companies choose the best option for their situation. Determining the value of a company is a critical step in any M&A deal. Common valuation techniques include discounted cash flow analysis, comparable company analysis, and precedent transactions. Each method has its strengths and weaknesses, and the right approach depends on the specifics of the deal. Accurate valuation ensures fair pricing and helps prevent disputes. Synergies are one of the main reasons companies pursue mergers and acquisitions. Synergies occur when the combined company is more valuable than the sum of its parts. This can result from cost savings, increased revenue, or improved capabilities. Identifying and realizing synergies is essential for deal success. Mergers and acquisitions are not without risks. Deals can fail due to cultural clashes, integration problems, or unexpected financial issues. Sometimes, anticipated synergies don't materialize, leading to disappointment for shareholders. Understanding the risks and planning for them is crucial for any successful M&A strategy. One of the biggest challenges in M&A is integrating company cultures. Differences in values, work styles, and management approaches can create friction. Successful cultural integration requires open communication, respect for differences, and a clear vision for the future. Companies that manage this well are more likely to achieve their goals. M&A deals can have a significant impact on shareholders. Share prices may rise or fall depending on how the market views the deal. Shareholders may receive cash, stock, or a combination as part of the transaction. It's important for companies to communicate clearly with shareholders and address their concerns throughout the process. Employees are often deeply affected by mergers and acquisitions. Changes in leadership, job roles, and company culture can create uncertainty and anxiety. Companies must manage these transitions carefully, offering support and clear information to help employees adapt. Retaining key talent is essential for long-term success. Customers may also feel the effects of M&A activity. Changes in products, services, or pricing can influence customer loyalty and satisfaction. Companies need to communicate with customers, maintain service quality, and address any concerns to ensure a smooth transition and protect their brand reputation. Cross-border mergers and acquisitions involve companies from different countries. These deals can open up new markets and create global opportunities, but they also bring additional challenges. Differences in regulations, cultures, and business practices must be carefully managed to ensure success. Regulatory challenges are especially significant in cross-border deals. Companies must comply with laws in multiple countries, which can be complex and time-consuming. Antitrust concerns, tax issues, and foreign investment rules all play a role. Expert legal and financial advice is essential for navigating these hurdles. Famous example of a successful acquisition is Disney's purchase of Pixar. This deal combined Disney's distribution power with Pixar's creative talent, resulting in a string of blockbuster films. The integration was smooth, thanks to shared values and a clear vision. This case shows how the right deal can create lasting value for both companies and their stakeholders. Not all M&A deals go smoothly. The merger of Daimler and Chrysler was initially hailed as a match made in heaven, but cultural differences and strategic misalignment led to disappointing results. This case highlights the importance of cultural integration and clear objectives in any merger or acquisition. The merger of AOL and Time Warner is often cited as one of the most disastrous deals in history. Overestimating synergies and underestimating cultural differences led to massive losses. This example serves as a cautionary tale about the risks involved in large, complex mergers. Private equity firms are major players in the M&A market. They buy companies, improve their operations, and eventually sell them for a profit. Private equity deals often involve significant restructuring and can lead to rapid changes in management and strategy. Their involvement adds another layer of complexity to the M&A landscape. Technology is transforming the M&A process. Advanced analytics, artificial intelligence, and digital platforms make it easier to identify targets, conduct due diligence, and manage integration. Technology also enables better communication and collaboration between teams. As digital tools evolve, they are reshaping how deals are done. The M&A landscape is constantly evolving. Recent trends include increased cross-border activity, a focus on technology-driven deals, and growing interest from private equity. Companies are also paying more attention to environmental, social, and governance (ESG) factors when evaluating deals. Staying on top of these trends is essential for anyone involved in M&A. Environmental, social, and governance (ESG) considerations are becoming increasingly important in M&A. Companies are looking at how deals affect their sustainability goals, social responsibilities, and governance structures. ESG factors can influence deal value, regulatory approval, and public perception. Integrating ESG into M&A strategy is now a best practice. Looking ahead, the future of mergers and acquisitions promises to be dynamic and challenging. Technological advances, shifting regulations, and changing market conditions will continue to shape the landscape. Companies that adapt quickly and embrace innovation will be best positioned to succeed in the evolving world of M&A. For companies considering a merger or acquisition, careful planning and expert advice are essential. It's important to set clear objectives, conduct thorough due diligence, and communicate openly with all stakeholders. By focusing on strategy and execution, companies can maximize the chances of a successful deal. Investors should pay close attention to M&A activity, as it can significantly impact stock prices and long-term value. Understanding the motivations behind deals, the risks involved, and the potential for synergies can help investors make informed decisions. Staying informed and seeking professional advice is always a wise approach. Employees facing a merger or acquisition should stay informed and proactive. Embracing change, seeking clarity from leadership, and focusing on personal development can help navigate transitions. Companies that support their employees through these changes are more likely to retain talent and maintain morale. Customers should watch for changes in products, services, or pricing following a merger or acquisition. Staying engaged with the company and providing feedback can help ensure their needs are met. Companies that prioritize customer satisfaction during transitions are more likely to retain loyalty and protect their brand. Certain regions are particularly active in the M&A market. North America, Europe, and Asia Pacific lead the way, driven by strong economies and vibrant industries. Each region has its own trends, challenges, and opportunities. Understanding these hotspots can help companies and investors identify where the next big deals might happen. M&A activity often follows economic cycles. During periods of growth, companies are more likely to pursue deals to expand and innovate. In downturns, distressed sales and consolidations become more common. Understanding how economic conditions influence M&A can help companies time their moves for maximum advantage. Mergers and acquisitions are powerful tools that can reshape industries, create value, and drive growth. However, they also come with significant risks and challenges. By understanding the motivations, processes, and potential pitfalls, companies and investors can make smarter decisions. As the world of finance continues to evolve, staying informed about M&A will remain essential for success.